Today we will be looking at a monster stock that returned more than 2,000% since its inception and has absolutely destroyed the S&P 500 index's performance during the same period. The stock chart reveals an almost perfect track record in the past 20 years, with only a recent slowdown, offering a rare buying opportunity in a truly exceptional company. Will MSCI stock bounce back and potentially grow your wealth exponentially in the near future? In this video, we will determine the intrinsic value of MSCI stock and its potential future compounded annual return using the DCF model, a method endorsed by legendary investor Warren Buffett. A detailed explanation for this model was covered in a previous video. Make sure to check it out if you haven't already. On this channel, I will continue uploading videos to share my value investing techniques and the hard lessons I've learned over the past 6 years as I built my portfolio to over 600K from scratch. Be sure to subscribe if you're interested in learning more. Before we start, let's review the criteria that a company has to satisfy to ensure that it can generate predictable cash flow in the future. This is a necessary process before DCF model can be applied. Finding a company with strong economic moats is like discovering a money printing machine. To determine the moat of MSCI, we must first learn how the business operates by reading the business section of its annual report. Let's head to their website and download the report. If you're considering investing in the company, I highly recommend reading this section line by line. But in this video, I'll save you time by summarizing their business model for you. The indexing business is a crown jewel of MSCI. Being the third largest provider just behind S&P and FTSE Russell, MSCI has built a successful indexing franchise with a focus on international equity market. A few examples are the iShares Emerging Market Index ETF and the iShares MSCI EAFE Index ETF, which invests in top companies across prominent developed countries. MSCI charges a percentage fee based on the total amount of asset managed in these ETFs, which is incredibly high-quality earnings, with exceptional margins and scales, well with hardly any additional costs. With hundreds of billions of asset under management and continuous inflows, thanks to the rise of passive investing, the profits will only continue to grow for MSCI in the near future. It's easy to see that entering the indexing business is extremely challenging for new companies. Building a brand strong enough that people are willing to entrust billions of their hard-earned dollars to it is hard to imagine. To be 100% sure about our investment thesis, let's take a look at the economic moat section of the Morningstar Analyst Report. Here we discovered that MSCI also earns subscription revenue from performance benchmarking. Because index benchmarks are critical to asset owners, managers, and consultants, which often have little incentive to switch benchmarks. Once an index becomes dominant in a segment, it tends to stay that way. The asset manager would risk outflows if they change their benchmarks without sound reasons. This is the exact feature of an economic moat based on high switching costs. If we scroll down a little bit further, we will discover that the analytics segment of the business also has a competitive advantage. Because the analytics applications are embedded in clients' workflows, there are switching costs, and firms don't take the decision to switch providers lightly. Now you've got all the valuable information about MSCI's economic moat that ensures its profitability in the future. That said, it is highly recommended that you read the entire Morningstar report. You can find out how to access this report for free in the description below. If you are still watching, congratulations, you have finished the hardest part of the video. Just give me a few more minutes of your focus and you will be surprised how simple the stock valuation process is. Here are the financial performance we will be looking for. I will be demoing the process using a free website called quickfs.net. Let's search for our company, MSCI by name, which will navigate us to a page with all the necessary information. We can see that the 10-year revenue growth is 10.7%, much higher than our 5% requirement. And if you look at the revenue number year by year for the past 10 years, there isn't a single year of declining revenue, which is absolutely amazing. This is a strong indication that economic moats actually exist. The next metrics to check are the EPS growth and the 10-year average return on invested capital. The EPS growth rate can be easily found under the key statistics. At 22.9%, it is much higher than our 10% requirement. The ROIC data can be found at the bottom of the page, and it is obvious that the 10-year average is higher than 10%, with only 1 year missing by a tiny gap. Insiders such as fund managers and company executives have access to information that retail investors don't possess. To reinforce our investment thesis in MSCI, we need to check what insiders are doing with their shares. First, let's go to dataroma.com to see if there are any super investors holding the stock. Here we can see that there are some existing ownerships, notably from Poland Capital Management, which recently made significant purchases. On top of that, various funds had made purchases without any sales in the recent quarter, which is a good sign. However, MSCI ownership is less than 5% in all of the funds, so we can't clearly determine insiders' opinions on the stock based on this data alone. Next, let's check if MSCI executives own a significant portion of the company using a website called simplywall.saint. This information is available under the Management tab. We can see that the CEO owns $1.1 billion worth of shares, which is much higher than his annual compensation, and that's some serious commitment. The president of the company also owns a significant number of shares, and if we scroll down, we can see that insiders have recently bought more shares than they've sold. This indicates that MSCI insiders are highly optimistic about the company's future, as demonstrated by their significant stock ownership, which allows the stock to meet the insider ownership requirement. Most retail investors lose money in the stock market because they don't know the true value of their stocks. They often get emotional when the market fluctuates, leading them to buy and sell at the wrong times. The DCF model helps you determine the intrinsic value of a stock, giving you a massive advantage over other market players. Let's first review the data required by the model before we run the DCF calculation. If the rate of dilution is positive, it means the company is printing shares to raise more capital. This is bad for existing stockholders as it dilutes our share of profits earned by the company. Rate of dilution can be found on the quickfs.net by going to the key ratios screen. Under the year-over-year growth section, our desired data is on the row of diluted shares. Here we can see that all rates are negative, which is great because it indicates MSCI is consistently buying back shares, increasing our ownership in the business. We will use the 5-year average rate of dilution for our DCF model. Let's calculate it and write it down. The future free cash flow growth rate can be estimated using the average free cash flow growth rate of the recent 5 years. This data can be found on the key ratios screen. Under the year-over-year growth section, we can easily calculate the average using the recent 5 years of data. Price to free cash flow ratio is not available for free. However, we can still calculate it easily. Let's go to the key ratios screen and scroll down to find the per share items and valuation metrics section. We are now able to calculate the price to free cash flow ratio by first multiplying the price earnings ratio and the diluted EPS, and then divide it by the free cash flow per share. To get the average ratio for the recent 5 years, we can run this calculation easily on a Google Sheet to quickly get the result. The maximum ratio I will ever use is 30. Anything higher is too much to expect from a stock, which will lead to risky investments. Even extremely successful companies like Visa and Meta Platforms are trading at a price to free cash flow ratio lower than 30. Discount rate is the rate of return we demand from investing in MSCI stock. I always use 10% for the DCF calculation. Using higher discount rate will make the DCF model return a lower valuation for a stock, making most high-quality companies appear expensive. This can lead to significant missed opportunities. I've seen many smart investors wait on the sidelines for their favorite stocks to decline to their calculated price, only to watch the share price continue to rise year after year, leaving them in the dust. These data can be easily found by visiting the Yahoo Finance website. Type to search for MSCI and click on the Financials tab, then click on the cash flow statement. On this page, you can calculate the free cash flow by subtracting the investment in property, plant, and equipment amount from the net cash provided by operating activities. Next, we can find the total shares outstanding by clicking on the Statistics tab. You made it. You have finally gathered all the data required by the DCF model. Simply use this Google Sheet template or any online DCF calculator you like to perform the valuation. I have provided the links in the description below. The resulting valuation for MSCI is approximately $608 per share. The stock is currently trading at $573 as of September 3rd, slightly below its intrinsic value, which implies an 11% compounded annual return over the next 5 years. Given that the stock is not selling at a significant discount, it is wise to purchase it as a part of a diversified portfolio. I would personally limit it to no more than 5% of my overall portfolio to manage risk exposure if I decided to invest in MSCI stock. By the way, if you wish to level up your wealth into the next level and unlock the ultimate freedom, make sure to show some love by hitting the like and subscribe button. See you next time.